Don't invest too much at once. IPO stocks are known for their high volatility, especially in the first few months of trading. This volatility is driven by a variety of factors, including investor sentiment, uncertainty about the company's future performance, and the release of new information. For example, a company that reports lower than expected earnings in its first quarterly report as a public company may see its stock price drop sharply. Given this volatility, it is advisable not to invest a large portion of one's capital in an IPO right away. Instead, consider adopting the dollar-cost averaging strategy. This involves investing a fixed amount of money at regular intervals, regardless of the stock's price. By doing so, investors buy more shares when the price is low and fewer shares when the price is high, which helps to smooth out the impact of price fluctuations over time. Let's take an example to illustrate the benefits of dollar-cost averaging. Suppose an investor decides to invest yuan in an IPO over 5 months. In the first month, the stock price is 20 per share, so they buy 500 shares. In the second month, the price drops to 15, and they buy 67 shares rounded up. In the third month, the price rises to 25, and they buy 400 shares. In the fourth month, it drops to 18, and they buy 556 shares. In the fifth month, it rises to 22, and they buy 455 shares. Over the 5 months, the investor has bought a total of 2578 shares at an average price of approximately 19.39 per share, which is lower than the average of the monthly prices 20家、15家、25家、18家、22 5等于20美元。This shows how dollar-cost averaging can reduce the impact of volatility and potentially lead to a lower average purchase price. Investing too much at once in an IPO can expose investors to significant risk. If the stock price plummets shortly after listing, a large initial investment could result in substantial losses. By spreading out the investment over time, investors can limit their exposure to short-term price swings and give themselves more time to assess the company's performance as a public entity. You don't have to seize the first opportunity. There is a common misconception that the only way to profit from a company's growth is to invest in its IPO. However, history has shown that many of the most successful companies continued to deliver strong returns long after their initial public offerings. Companies like Apple, Amazon, and Google, now Alphabet, are prime examples. Apple went public in 1980 at a price of 22 美元 per share adjusted for splits. Over the years, the company has innovated and expanded its product line, from the Macintosh computer to the iPhone, iPad, and Apple Watch. Investors who bought Apple shares years after its IPO, say in the early 2000s when the company was struggling but on the verge of launching the iPhone, have seen their investments grow exponentially. Amazon's IPO in 1997 as priced at 18 美元 per share. In its early years, the company focused on building its online retail business and incurred significant losses. However, investors who had the patience to hold onto their shares as Amazon expanded into cloud computing, Amazon Web Services, streaming services, and other areas have been handsomely rewarded. The stock has split multiple times, and the price has increased by thousands of percentage points since its IPO. Google went public in 2004 at 85 美元 per share. The company's dominance in the search engine market, along with its expansion into advertising, mobile operating systems, Android, and other tech ventures, has driven its stock price higher. Investors who bought Google shares several years after its IPO still enjoyed substantial gains. These examples demonstrate that there is no rush to invest in an IPO. Investors who miss out on the initial offering can still profit by buying the stock later, once there is more information available about the company's performance as a public entity. This approach allows investors to avoid the uncertainty and volatility of the IPO period and make more informed decisions based on actual results rather than hype. It is important to avoid the all-or-nothing mentality when it comes to IPOs. Investing should be a long-term strategy, and there are plenty of opportunities to profit from huge companies, high-quality companies over time. By taking a rational, phased approach to investing, investors can reduce their risk and increase their chances of success.